Hi everyone, my name is Edwin Lee. In this video, we will cover topic 5. We will first define internal controls and understand the importance and limitations of internal controls. Internal controls help companies to achieve strategic objectives, and they help companies to comply with laws and regulations. They can also ensure the quality of financial reporting. In this topic, we focus on internal control of cash. Because cash is liquid and it is almost anonymous in nature, cash is easily subject to theft and misappropriation. As part of the internal control, we will perform a bank reconciliation to explain the difference between cash at bank ledger account balance and the bank statement balance. We will also cover petty cash that is used for small amount expenses. Then we finish up with cash budgeting. Cash budgeting is part of cash management to ensure that the company has enough cash to operate and the company has the ability to meet short-term obligations. If the company is expected to have a deficit cash budget, it should obtain short-term loans. On the other hand, if the company is expected to have a surplus cash budget, it can invest to generate more income. Make sure that you go through the learning objectives. Before we go through today's topic, let's go through the revision question 4 or case study 4. What is this case about? If you have read the article, you know that the former CEO and CFO of Sigma Pharmaceuticals Limited falsified accounting records and they provided misleading information to the market. And this was caught by the regulator, the SEC. So what happened here is the former CEO and CFO arranged Sigma to purchase the wholesale drugs at inflated prices. So let's say if the drug could be purchased from the supplier at a cost of $1, just for illustration, Sigma purchased it at $2. So when the inventory was purchased, the following entry will be recorded. Debit inventory, and credit cash. And what happens to the inflated payment? The inflated payment is returned by the supplier to Sigma and recorded as revenue in the form of cash rebates or discounts. So for example, Sigma will have recorded debit cash, $1 for the inflated price, which is returned to the company, and credit revenue. In this case, we find that Sigma has artificially inflated the revenue because when revenue increases, profit increases as well. And we find that Sigma has also inflated inventory by $1. So it actually states the inventory at a higher cost. So this was actually caught by the regulator, and the CEO and the CFO were removed from their positions and face criminal offense. In the first question, we need to understand why the former CEO and CFO falsified accounting records. What are their incentives? There are various possible reasons. The first incentive is to meet performance targets. Managers are self-interested parties who try to maximize their income, so they will like to receive more bonus. And quite often, bonus is linked to revenue and profit figure. So they inflated revenue and profit to obtain more bonus. Another potential incentive is to comply with debt covenants or loan agreements. When companies sign the loan covenants with banks, they are bound by terms and conditions. Companies are required to maintain a degree of profitability, liquidity, and leverage ratio. Say, for example, debt to asset ratio. So by inflating the inventory, companies are actually inflating the total asset as well. So when total asset increase, this will reduce the entire debt to asset ratio. And a lower debt to asset ratio indicates lower risk. Another incentive that we can mention is to probably meet or beat analyst earnings forecasts. Because Sigma is a listed company, the market is always watching the performance. If the company fails to meet certain earnings target, there will be negative share price reactions. And of course, you may think of other plausible incentives. So feel free to use the discussion forum to discuss it further. Let's look at the next question. In this case, the SEC, which is the regulator and corporate watchdog, sanctioned the CEO and CFO. Reflect, why do we need regulation in financial reporting? Again, this is an open question. There are several points that you can consider. First, we need to make sure that every company complies with accounting standards when preparing financial statements to maintain the quality of information. Better quality of information leads to better decision making. Regulation can also increase investors' confidence, and when investors feel comfortable and protected, they are more willing to invest, and this can stimulate economic growth. Next, regulation can increase efficiency in allocating capital. If there is no regulation, companies hide information or they provide misleading information, and investors will lose money. So we need regulation to make financial reporting and disclosure compulsory so investors make the right investment decisions. The next advantage is related to standardization. With regulation, we control the timing, content, and format of disclosures, so this can ensure the comparability of information. Also, by making financial reporting and disclosures compulsory, regulation can lead to cheaper production costs of information. Individual investors do not have to waste money searching for information because they can simply access to the company's website to obtain the annual reports, for example. Finally, when information is made available through regulation, investors can check on managerial perquisites. In other words, investors can rely on accounting information to evaluate manager performance, to judge whether managers deserve the remuneration and bonuses they receive. Alright, let's go through today's topic. So what is internal control and why is it important? Internal control is the systems the entity adopts to, first, to safeguard the entity's resources. Entity has limited resources. They need to make sure that resources, including funds, are appropriately and efficiently spent. They need to prevent wasteful activities and fraud. Management and employees cannot use the resources without prior approval. Second, that is to promote reliability of accounting data. It makes sure that the transactions recorded are supported by source documents. There are no fictitious transactions, so it actually helps to ensure that accounting estimates are appropriate and reliable. It also ensures that management complies with company policies to achieve objectives, and it also ensures that companies comply with regulation to maintain the business license. An effective internal control has the following advantages. First, it helps to prevent, detect, and correct any financial irregularities. Irregularities are abnormal transactions which are not driven by errors. Irregularities show managerial intention to cheat. So good internal control can prevent this. Next, internal control can protect our assets and make sure that resources are only for authorized use. Finally, internal control ensures the quality of financial statements and timely disclosures. So investors can rely on accurate data to make decisions in a timely manner. Internal control itself is a huge topic. This slide lists only a few features of internal control. You will get to learn more internal control designs in more advanced auditing and corporate governance units. So what are some features? First, led from the top. Management should set the rule and set the tone for employees to follow. If management does not show commitment in internal control, employees will think that it is not important to follow. Second, we need competent employees to run the organization and help achieve business goals. To attract capable employees, we need to reward them fairly and we need to motivate employees. If an employee feels unfair or demotivated, they will behave in a destructive manner or will not help achieve business goals. Third, the roles and responsibilities of directors, management, and employees must be clearly stated. This is usually reflected in the company's charter and employment contracts. Next, it is important to maintain effective records. We need to record our assets and how we spend our resources. All source documents and evidence must be preserved, digitized, and have a copy. And the next one is important, segregation of duties, meaning we need different people to perform different roles. Those who record transactions should not look after the assets and vice versa. Next, there should be rotation of duties, so any abnormal activities can be easily detected. We should have internal auditing. And what is the difference between internal auditing and external audit? Internal and external audits are different, and what are those differences? Internal auditors are appointed by management, so they are employees of the company. Internal auditors perform the work throughout the year. They need to check every transaction to detect fraud and errors. On the other hand, external auditors are appointed by shareholders of the company. They are independent parties. External auditors perform the work within a window period around the fiscal year end, and they perform sample testing and need to verify the true and fair view of financial statements. Next, we should have physical protection of sensitive assets. For example, we should lock our office, lock our filing cabinets, we have safes, and we install security cameras. We should assign and change passwords regularly. We should have firewalls and protective devices on computer systems so that our information don't get hacked. Next, we should have adequate insurance for the warehouse, office building, and so on. Finally, employees should take regular leave so their works can be easily audited. Internal controls are, however, not perfect. They are subject to the following limitations. First, management override, meaning management abuses the power and does not follow the rules, or the management just set his or her own rules. Or there is a collusion among employees. For example, one employee in the sale department and another employee in the transaction department can collude to cheat and earn personal income. Second, most controls tend to be directed at routine transactions. They fail to check for unusual transactions that need other type of control. Next, no internal control system is perfect. For example, our computer can still be hacked even if we have antivirus and firewall. You have heard about cyber attack probably, which means the systems of the company is hacked and locked. The company needs to pay a huge amount of money, say a few $1 million to the hacker if they want to resume the systems. Next, we can have very good design of internal control, but ultimately we rely on human to implement the internal control. But human is not perfect. Human errors such as carelessness, distraction, wrong judgment, and misunderstanding of instructions can make internal control ineffective. Finally, internal controls can be very costly, which may not be affordable to smaller business because they don't have enough resources. We must make sure that the benefits of internal control outweigh the costs. For example, in small business, usually the cashier will record the cash receipt, bank in the money, and maintain the account. This is not appropriate because recording and custody of the assets must be separated, so employees have no chance to cheat and engage in fraud. Alright, please remember that management is mainly responsible for internal control. Recall what we covered in the previous topic. In Australia, listed companies need to disclose whether they have followed the 8 corporate governance best practice or principles recommended by the Australian Securities Exchange, ASX. One of the principles is related to internal control. And we have listed some examples that show corporate failures in internal controls. They are only tips of the iceberg. For example, Barings Bank, the United Kingdom's oldest merchant bank, lost $1.3 billion and collapsed in 1995. Why? Because one of the employees, Nick Leeson, who was a former derivatives broker, engaged in unauthorized speculative trading. There was no segregation of trading and back office operations. So no one actually approved or verified the speculative trading. And all the losses were hidden in an account which is termed as 88888. And other examples include NAB 2005 currency trading scandal, which has caused $360 million of losses by one of the employees who falsified the records. And have a look at the Royal Australian Mint, which is your homework for this topic, where the case was presented in the last few slides. Alright, now we focus on internal control of cash. Why cash? Because cash is king. Cash is one of the most important assets to an entity. Why do we need to strictly control cash? Because cash is easily subject to misappropriation and fraud. It has the highest inherent risk due to the following reasons. First, cash is liquid and easily transferred, meaning you can spend it anytime you like. Second, cash is anonymous in its physical possession, meaning it cannot be easily identified, meaning if your employees use the cash for personal use, you won't know that immediately until you discover it. Because of these characteristics, cash is subject to misappropriation or the risk of theft. It is important that we implement internal control for cash and ensure that all cash transactions are recorded and the correct cash balance is reported in the balance sheet. One of the internal control for cash is to perform bank reconciliation procedure. So what do we do with bank reconciliation? Basically, bank reconciliation is to explain the differences between bank statement balance and the company's cash ledger account balance. Bank statement is an external document, but cash general ledger account is an internal record. We are required to identify whether the difference in balance is due to timing difference, because some checks may not have been processed by the bank, or because of human recording errors, or other reasons. For example, customers are facing financial difficulties, so the check was dishonored and bounced back. Any inconsistencies, omissions, and errors must be corrected immediately. Bank reconciliation serves as an internal control to prevent employee theft and money fraud. There are 3 main reasons explaining why the bank statement is different from the cash at bank account. First, there are transactions that are known to the bank and recorded in the bank statement but not yet recorded in the cash journals. Examples include bank charges and interest, dishonored check, meaning debtors or customers do not have enough money in their bank accounts to cover the amount of the check. They may also be direct debits or credits, meaning EFT payments or receipts. Second, they are transactions that are recorded by the company but have not been processed by the bank. Examples include unpresented check, which is also called outstanding check. They are checks drawn by the company and recorded in the company's cash payment journal, but not been cleared through the banking system. You also have deposits in transit, which is also called outstanding deposits or uncredited deposit. So those amounts have been recorded in the cash receipt journal, but they have not been recorded by the bank. Third, there may be errors made either by the company or by the bank staff. For example, transposition error. 231 is recorded as 213, and the bank may have incorrectly coded items to your bank account. For example, you receive a payment from an unknown party who is not your customer. Let's look at the format for the bank reconciliation statement. So we start with balance as per bank statement. This is the current month's balance. Note that in your bank statement, a credit balance indicates positive bank balance, meaning you have money in the bank. Because a bank takes our money, our saving is a liability from a bank's perspective. That's why our savings, our money in bank, will be presented as a credit on the bank statement. On the other hand, if you have a debit balance in the bank statement, it means you have a deficit. You have an overdraft, which is a liability to your company, but that overdraft is an asset to the bank. We then add deposit in transit, which is also called outstanding deposit, which are inflows to the company. Because banks have not recorded this amount, but the company had. So we need to add this amount to the bank statement balance. Then, we have to deduct outstanding checks or unpresented checks, which are outflows to the company. Because banks have not recorded this amount, but the company has. So we need to deduct this amount from the bank statement balance. Finally, we will add or deduct any bank errors depending on the case. This will give us adjusted bank balance per cash general ledger account, which is usually a debit. We also need to update the company's cash general ledger account. We start with cash balance per ledger account. This is calculated as opening balance plus cash receipts less cash payments for the month. Then we add receipts that are reported on the bank statement but not yet recorded by the bank. These inflows can include notes receivable, direct deposits, and interest. We then deduct bank charges and direct debits because these have appeared on the bank statement, but the company has not recorded these outflows. We then further add or deduct recording errors made by the firm, depending on the case. This will give us adjusted balance as per cash ledger account. And please note that the new items mentioned in this slide will need a journal entry because they have not been previously recorded. Alright, the first student task. You are required to prepare a bank reconciliation statement, update the cash general ledger account, and prepare the general journal entries for the company. Let's first identify where will each item go. If you look at item A, balance as per bank account in ledger as at 30th June, 26.2k, this will actually appear in the general ledger account. So it will appear in your cash general ledger account. Item B, balance as per bank statement as at 30th June, 34.631 credit, and this will appear in the bank reconciliation statement. Item C, deposits not reflected on the bank statement So this is deposits in transit, $4,600. This will also appear in your bank reconciliation statement. Next, we have item D, unpresented checks on 30th June, $12,000. So this will appear in the bank reconciliation statement as well. Have a look at item E, service charge on bank statement not recorded in books, $300. So this will appear in general ledger. And because it is a new entry, you also need to record it in the general journal account. And finally, check for shipping expense, $800, incorrectly recorded in the books as 1560. So in other words, you have over-recorded your expense by $760. So this error is done by the company, not the bank. This will appear in the general ledger account as well as general journal. So for the bank reconciliation statement at 30th June, we will begin with cash balance per bank statements, which is 34631.8 credit. We add deposit in transit 4,600, and we deduct outstanding check, which is 12571.8. This gives us the balance per cash at bank ledger account 26660 debit. In the second requirement, we need to update our cash at bank ledger account. So we start with bank balance per general ledger 26200 debit. Because we have over recorded our shipping expense by 760, we need to add this amount back to our cash account. So add check correction error 760. We then deduct bank charges that have appeared on the bank statement but not yet recorded by the company, which is $300. So this gives us the adjusted balance per cash at bank account 2660 debit. So you'll find that the two figures in part 1 and part 2 will be the same. So this means you have successfully reconciled the statement. In the third part, we are required to provide journal entries. So first of all, we will debit cash at bank credit shipping expense for the recording error, because previously we over recorded the shipping expense and payment by 760. So now we have to reverse the entry. We then debit bank charges and credit cash at bank $300 because this amount has not been recorded by the company but has appeared on the bank statement. The previous student task is only a simple example when every information has been summarized and provided. What if we were to start from scratch by looking at those documents? So we will briefly discuss the step to do a bank reconciliation, and then we go through an example. So what are the steps? First, we need to have the following documents: this month bank statement, last month bank reconciliation, and this month's cash receipt journals and cash payment journals. Second, we will compare every item on the bank statement with the last month bank reconciliation and the cash payment journals as well as the cash receipt journals. And for those items that are matched, we will give a tick, meaning they have been recorded by both the company and the bank. And you need to make sure that the check numbers are consistent. And note that in the bank statement, credit column represents inflows or receipts, but debit columns means outflows or payments. The remaining ones are unticked items. In step 4, we need to update our cash receipt and cash payment journal for items that appear on the bank statement but not yet recorded by the company. So this can include bank charges, interest paid or received, and dishonored check. Then in step 5, we need to look at our cash journals and last month bank reconciliation statement. Circle those unticked items, and these represent items that have been recorded by the company but not yet appeared in the current month bank statement. This can include outstanding checks and deposits in transit. In step 6, we will total cash journal and post to the bank ledger's account. And as the final step, we will prepare the bank reconciliation statement for items that we have identified in step 5. So what does all this mean? Let's go through an example so we can clearly see how this is working. Let's go through an example. In slide 18 and 19, you are provided with last month's bank reconciliation statement at 31st July 2016. You are also given the current month's bank statement, and you have cash payment journal and cash receipt journal for this month in the next slide. So please spend a few minutes by comparing bank statement with bank reconciliation and the bank statement with the cash journals in the next slides. For those match items, give them a tick. So let's say you have done the comparisons, you find that the items are matched. What are not matched? In your bank reconciliation statement, check 509 is still not processed. So you need to include this check in this month's bank reconciliation again and probably follow up with the bank or the related party. And you find that a few items are not yet recorded in your cash journals. These include $9 of bank charges, which you need to update your cash payment journal, CPJ. And you find that you also have $20 of interest revenue, which you have received, but you have not recorded. So you need to update this $20 in your cash receipt journal. Moving on. This is your cash receipt journal. After matching with your bank reconciliation statement, most of the items are matched, except the interest revenue of $52 has not been processed by the bank yet. So this represents deposit in transit that will appear in your bank reconciliation statement. And this is your cash payment journal. After matching with your bank reconciliation statement, most items are matched, except the following checks: 516, 518, 519, and 520. They represent outstanding checks that will appear in your bank reconciliation statement. The next thing is to update your cash at bank general ledger account. Ledger account has two formats. In the past, we used T accounts. In today's topic, we present the second format, which is what you have seen here, the running balance method. Under the running balance method, after every single line of entry, we will update the balance immediately. So first of all, we insert the date 1st August 2016, opening balance 4720 debit, which is from the previous month bank reconciliation statement. So if you go back to your bank reconciliation statement, the previous month's bank reconciliation statement, that is the figure 4720. This is because in the previous month, you have adjusted the bank balance statement as cash at bank ledger account closing balance. Then you will debit 3463 as cash receipts. This is calculated as 3443 from your cash receipt journal plus $20 of interest receipt as shown in the bank statement, but you have not previously recorded this. So now you have to record. And this gives you the running balance 8183 debit. Then you credit 3838 for cash payment. This is calculated as 3829 from cash payment journal plus $9 of bank charges, which have been shown in the bank statement, but you have not previously recorded this. So you have to now record it. This will give you the closing balance debit 4345. for cash at bank account. Finally, let's prepare the bank reconciliation statement for this month. So the title is Bank Reconciliation Statement as at 31st August 2016. We start with cash balance as per bank statement, which is credit 4891. So remember, in your bank statement, if the amount has a credit balance, it means you have a normal balance in the bank. You have money in the bank. We add deposit in transit $52 and we deduct all outstanding checks that we have previously identified. That is a total of 598, and this will give us a debit balance per cash at bank account 4345. So this figure is the same compared to the previous slide. So you have two consistent figures and consistent debit balance here. That means you have successfully conducted the bank reconciliation. Another student task. So based on the information presented in the next slide, update the current month's cash at bank account using the running balance format and prepare the current month's bank reconciliation statement. So we need to compare the left-hand side statements or journals with the right-hand side bank statement. So let's say if you have attempted this question, after comparisons, we find that in the previous month's bank reconciliation statement, check 112 has not appeared in the bank statement. This is outstanding check that will appear in this month's bank reconciliation statement. When we look at cash receipt journal, on 20th, there is actually a recording error. It was recorded as 5908 by the company, but in the bank statement, it was actually 5890. So let's assume that the amount recorded by the bank is correct. Then we need to update our cash receipt journal because we have over-recorded our cash receipts by $18. So later in our cash receipt journals, we need to deduct by $18. Also, we find that 5672 has not appeared in the bank statement. So this is actually deposit in transit. They will appear in this month's bank reconciliation statement. And in the cash payment journal, checks 117 and 119 have not been processed by the bank. So they actually represent outstanding checks that will appear in this month's bank reconciliation statement. The June bank statement shows that there is a $44 of bank fees, so we need to update our CPJ, our cash payment journal, because this is an outflow. And we also have NSF check, which means known sufficient fund check or dishonored check. And how much is the known sufficient check? 4421.4. So we need to update our cash receipt journal by deducting this amount. And finally, we also have received dividends, but we have not recorded it. So we need to update our cash receipt journal by adding this amount. So after we have analyzed those documents, let's update our cash at bank account. So we insert the date 2016 1st of June, opening balance 21292.6 debit. This is from the previous month's bank reconciliation statement, because in the previous month we have adjusted bank balance statement as cash at bank ledger account closing balance. Then we need to debit 17712 as cash receipts, and this is derived from 21151.4 cash receipt journal minus 4421.4 the dishonored check appeared on the bank statement, and we minus $18, which is the error on 21st of June receipt, and we plus $1,000 of dividend received on bank statement. That will give us the running balance 39004.6 debit. We then need to credit 16242.8 for cash payment, and this is calculated as 16198.8 cash payment journal plus $44 of bank fees on the bank statement. This will give us the closing debit balance of 22761.8 for cash at bank account. Finally, let's prepare the bank reconciliation statement for this month. The title is Bank Reconciliation Statement as at 30th June 2016. We start with cash balance as per bank statement, which is credit 21700.8. We get this amount from the bank statement final figure. Then we add deposit in transit 5672. And we less all the outstanding checks that we have previously identified with a total of 4611. This gives us a debit balance per cash at bank account 22761.8. So we have two consistent figures and consistent debit balance here. This will be a debit balance per cash at bank account. Alright, following this, we are going to look at petty cash. We set up petty cash fund to make payments for minor expenses such as postage, refreshment, and newspaper. The main reason for having a petty cash is to avoid the inconvenience and the cost of writing many checks with small amount. Cash is drawn from the company's bank account and it will be placed in a petty cash box. The petty cash box is kept securely and controlled by an employee. When payments are made from the petty cash, the authorized employee will fill in the petty cash voucher to document a disbursement as shown in this example. So this is actually an example of petty cash voucher. And it should be supported by a third-party receipt if possible. We will replenish the fund by the total amount spent to bring the account balance to the fixed amount. So for example, if we set $100 of petty cash every month, if this month we have spent $60, at the end of this month we have $40 of balance and we need to reimburse $60 in order to make sure that the next month we start with $100 again. So when we set up petty cash, we debit petty cash, credit cash at bank. When we replenish, we debit all the minor expenses and credit cash. Another student task. In this example, the company set up a petty cash fund of $300 on 1st December. The details for the disbursements were presented below. And note that the company reimbursed the checks on 16th December and 31st December. Provide journal entries. Because the company first reimbursed on 16th December, the first three will be recorded on 16th and the remaining will be recorded on 31st. And some of the transactions can be grouped because they are of similar nature. For example, if you talk about taxis and fares, they can be grouped as travel expenses. So what does this mean? So let's go through the journal entries and you can see a clearer picture. On 1st of December, when we set up the petty cash, we debit petty cash 300 and we credit cash 300. On 16th of December, we replenish the fund. So we debit individual expense, which includes $35 of travel expense. And this $35 of travel expense include $10 of taxi and $25 of fares and $34 of office expense. So we credit cash with a total $69. On 31st December, we also make another replenishment. So we debit postage 120, which equals to 40 plus 80. We debit travel expense 31, which equals to 8.5 plus 8 plus 14.5. We debit office expense 32, we debit stationery 10, and we credit cash 193. So all this exercise will make sure that we bring our petty cash back to $300 at the start of next month, meaning we keep the balance intact. Okay, in the next few slides, we will go through cash budget. Cash budget shows all the expected sources and uses of cash. In other words, what are the expected cash inflows and outflows? To prepare cash budgets, we need to collect data from schedules of cash receipts and schedules of cash payments. Cash budget is different from budgeted income statement because the movement of cash does not equate profitability. Because profit can include known cash or unrealized income and expenses. For example, we will consider depreciation when we calculate profit, but depreciation has no cash flow effect. So why is cash budget important? A cash budget is a planning tool for management decisions. It helps managers to evaluate and plan for capital needs. If firms are expecting deficits, they should obtain short-term borrowings. If firms have surpluses, they can consider short-term investment. It is important for companies to make sure that they have enough cash balance for the following reasons. First, companies can take advantage of cash discounts. If they have excess cash, pay suppliers earlier, or buy inventory in bulks to enjoy the discount. Companies quite often need to maintain a degree of liquidity to comply with debt covenants or loan agreements and maintain credit ratings. Because if companies breach the condition, they will suffer from poorer ratings and they will suffer from higher interest rates on loans. Companies can also take advantage of business opportunities with excess cash, meaning if they have excess cash, they should expand the business and invest. Companies need to also have some cash to cushion some unexpected factors or to meet emergencies, for example, natural disaster and strikes. There are 5 steps in preparing cash budgets. We begin with opening cash balance, which is the previous period's closing cash balance, plus expected cash receipts from all sources, including sales, investments, and so on, minus expected cash payments to suppliers or payments for loans and interest, and for all sorts of operating expenses that require cash outflows. Please do not include expenses that have no cash effect. For example, we do not include depreciation and impairment. This calculation will tell us whether we have excess or deficient cash, and we can plan for financing and investing activities accordingly. For example, if we have deficiency, we need to obtain loan or overdraft. If we have excess cash, then we will repay loan or we will reinvest, and that will lead to ending cash balance. Let's go through an example through the student task. In this case, the company makes sales on credit. So all sales are made on credit. 30% of the receivable is collected in the same month when the sale is made, and the remaining 70% is collected in the month following the sale, meaning in the next month or the subsequent month. The opening accounts receivable is 60K, and the sales budget from July to December is provided. We are required to first calculate the cash receipts for the 3 months ended 30th September 2017. So please change the date to 2017. Sorry for the error. In this table, we first fill in the expected cash receipt from month of sale for July, August, and September, and the quarter total. The company makes all sales on credit. So 30% of receivable is collected in the same month when the sales is made. In July, we will collect 30K, which is 30% of 100K July sales. In August, we will collect 36K, which is 120K, August sales times 30%. In September, we will collect 33K, which is 100K September sales times 30%. The quarter total is 99K. Then let's fill in the cash receipt in the following month of sale. In July, we will collect 60K because the remaining of accounts receivable in June, 60K will be fully collected in July. In August, we have 70K from 70% of July sale. In September, we have 84K from 70% of August sale. And this will give us the total 214. We then sum the total budgeted cash receipts, 90K for July, 106K for August, and 117K for September. And the total for the quarter is 313K. So that is the schedule of cash receipt. Following this, we are required to prepare cash payment budget. Note, this is a very important information. Cost of goods sold equals to 65% of sales revenue, meaning the company pays suppliers at this amount when they purchase the goods. Monthly fixed costs include 5K rent, 3K insurance, and 2K wages. All these will have cash effect. They are cash outflows and they are paid in the month in which they are incurred. And you are also given the depreciation charges, $4,000 per month. Please ignore the depreciation because it has no cash effect when we prepare the cash budget. And note that the company pays 7% commission on sales, but when do they pay the commission? They pay in the subsequent month, the following month, the next month. And the sales commission outstanding on 30th June 2017 is 7K. So this 7K will be paid in July. And again, we will prepare 3 months budgeted cash payment from July to September. Let's fill in the figures. Payment to suppliers in July is 65K, 65% of July sales. For August is 78K, which is 65% of August sale. For September is 71.5K, which is 65% of September sales. The total is 214.5K. Rent is fixed for the 3 months, 5K each, so 15K in total. Insurance is fixed for 3 months, 3K each, so total 9K. Wages is fixed for the 3 months, 2K each, total 6K. Sales commission. The June outstanding commission 7K is paid in July. For August, it is also 7K, but it is calculated as 7% of July sale. September is 8.4K, which is 7% of August sale, and this gives to the total of 22.4K. Total budgeted cash payments are 82K for July, 95K for August, 89K for September, and for the quarter, the total is 266.9K. After preparing the schedules of cash receipts and cash payments, we can prepare the cash budget. Net cash inflows is calculated as budgeted cash receipts minus budgeted cash payment. And additional information, the opening cash balance is 5K and the interest is 12%. So meaning if we have deficit, we need to obtain a loan. Then we have to pay 12% of interest. On the other hand, if we have excess, if we have surplus, we will invest and the interest is 12%. That is the amount that we will receive. So we need to prepare 3-month cash budget from July to September. So let's do the cash budget. We need to do this month by month. So we need to look at July first. So July opening cash balance is given $5,000. We add 90K cash receipt calculated from the previous slide minus 82K cash payment from the previous slide. So we have excess of 13K. Because we have excess, we have surplus, we will invest this money. We get 12% return. we get 12% interest, 1560. So the total budgeted cash balance in July is 14560. Then let's look at August. In August, we start with 14560. That is the closing balance from July. And we add 106k, cash receipt calculated from the previous slide, less 95k cash payment from the previous slide. We have an excess of 25560. Again, because we have excess, we will invest and receive 12% interest, 3067. And this will give us a closing balance of 28627. And let's look at September. We do the same thing. Opening cash balance is 28627, which is the closing balance from August. We add 117k from the calculated from the previous slide, and we deduct 89.9k cash payment calculated in the previous slide. So we have an excess of 55727. Again, because we have excess, we will reinvest and we will get 12% of interest, 6687. This will give us the closing balance of 62414. And we can simply sum the 3 months for the quarter total. So that's it for the cash budget and for this topic. Please attempt this question and we will discuss at the start of the next topic.